Mahindra Finance is a market leader in vehicle financing, predominantly in tractor and Mahindra UV segments. The company is driving its transformation agenda by adding new verticals and embracing technology to complement and strengthen its core business. Mahindra Finance has put out a 3-year roadmap called Vision 2025, aiming to improve AUM, cost ratios, stabilize asset quality and NIMs to achieve a higher ROA. While all ingredients are there for a success story, the moot question remains, is the stock a worthy bet at current levels? As the company focuses on moderating its credit costs, RBI's ban of 22nd September this year on recovery or repossession by third party could be a roadblock. The deterioration in asset quality until the ban is revoked, which could impact 75 to 80%, this could be followed by higher credit costs. However, it might not have a material adverse impact on the financials, as these vehicles to be repossessed are already classified under gross stage 3 assets. Transforming and stabilizing business operations by changing customer mix, increasing non-vehicle shares such as SME, LAP, and going digital with DigiFinco and Quick Lease is also something that the company is focusing on. Let's look at the new growth engines, SME, leasing and digital small ticket lending business, which is DigiFinco. The company plans to invest heavily to scale these segments and capitalize on a large customer base of over 7 million customers by cross-selling its products. Mahindra Finance is digitizing its core business using cloud architecture, API platform and AI or ML-based models. Moreover, new digital business initiatives such as Quick Lease, which is car subscription program, and DigiFinco, these will not only ease up its relatively higher cost-to-income ratio, but also mitigate the risk with the help of VKYC, e-signatures, etc. Now, these businesses are gaining momentum as the company reported a sequential growth in SME asset book of around 30%. Apart from this, the company has put up collection war rooms and legal efforts, leveraging analytics and business intelligence to improve both business volumes as well as the collections. The funding profile reflects a broad-based liability mix, including foreign borrowings and banks, where on-lending to NBFCs is now considered a part of priority sector exposure. Strong parentage too is a source of comfort on the funding side. Growth in loan book and asset quality control on the back of strong collection efficiency led to a reasonable start to the year. Although margins remain steady on the back of low-cost borrowings, the quarter witnessed elevated OPEX and higher credit costs driven by high write-offs, resulting in PAT degrowth. Healthy growth in disbursement was fueled by positive macro sentiment and better monsoon, resulting in better rural demand. Improved cash flows and uptick in demand resulted in the highest ever advances in any first quarter of any fiscal. We expect the trend to continue in the light of the upcoming festive season. The company was also able to control asset quality with focused collection efficiency. Now, it also maintained adequate level of provision and it aims to lessen the volatility in its asset quality. Mahindra Finance has a robust business model and it's well equipped to deliver strong AUM growth riding on the growth in advances. The company breached pre-pandemic levels in terms of AUM as demand picked up in its core segments. As the inventory levels rise, we see uptick in advances to be fueled by both new and used vehicle segments. The company could be at the forefront of growth with strong penetration in the rural market, coupled with synergies derived from a strong parentage of the Mahindra Group. Valuation at 1.4x of FY24 estimated adjusted book looks reasonable on the back of company's leadership position and growth transformation. These strategic initiatives show a lot of promise. With recovery on a firm footing, we see reasonably strong earnings and the stock performance should ideally mimic the same. In a nutshell, Mahindra Finance is a long-term growth story. However, investors should watch out for any knee-jerk reaction coming in from the ongoing issue of RBI ban and how this could add to the pressure as the company gears up to implement the RBI NPA circular with effect from 1st of October. Of course, some other risks to watch out for will be economic slowdown, which could impact growth or asset quality, or pressure on margins due to high-cost liability and/or competitive pressure.